Welcome to Financial Investing Radio, where you'll learn the secrets for consistent, high-probability returns in the financial markets for additional income to change your life. Grant applies consistent, high-probability trading systems for the financial markets. He's only recently started sharing these tried and true market secrets. As a gift to listeners, Grant is offering his roadmap to high-probability financial control. Go to financialinvestingradio.com and download yours today. Now, here's your host and trading veteran, Grant Larson.
Hey everybody, this is Grant Larson, and welcome back to another episode of Financial Investing Radio. Again, I am just pleased to have back with me for the third time Mr. Zach Morrow. Zach has been gracious enough to come back and answer some questions that I've got. So I've been thinking a bit about what he's told me. I've been discussing with my wife. We've been going back and forth about it, like really thinking about what's Zach been telling us, right? In terms of how to look at ways to grow and ensure some of your financial investments in a fairly secure way. And so I started thinking, okay, could this really work? Now, before I start going off with a bunch of questions, let me stop and let Zach say hello.
Good morning, Grant. I am excited to be here and look forward to going back and forth today.
Thank you so much for your time. You know, this is the third time around, and I appreciate you coming back again for this. This is the Rocky round, right? This is where we're like, okay, we've got some objections for you. Are you up for it?
I think we are going to be good. I look forward to hearing your questions.
Here we go. Okay, so here's the first thing. So I guess first and foremost, last time we talked, you described an entry level, right, where people need to get into. And when I think about a lot of people who want to grow themselves to get to something like that, who could really benefit from Boron long before, what benefits could I ever get from Boron long before I was ever able to invest at the levels that you're talking about? Can you describe that?
Yeah, to answer your question, what benefits you could get from working with us really is some of the content we put out, and then understanding the outlook and the way that we are looking at things, the way we are handling markets, and the way we are putting together our investments to bring forth that stability, to bring forth that quality protection and production.
All right, so let's say that as a potential investor, I've done some real estate investing before, and let's say that I've lost a lot of money. Now, that's acting as a self-directed investor. What I'd like to understand is you had talked about having this protection, and I think that is such a key part of this whole capability. And of course, obviously, remember last time I started saying, well, that's not really guaranteed, right? And I think you agreed with that, right?
Correct. So in real estate, and actually in investments in general, look, we all know there's no such thing as a guarantee in investments, or in life rather. And so when it comes to investments, what we're trying to do is mitigate risk to the lowest degree and to be able to find the most hedges of protection. We're trying to gain control in as many areas as possible to ensure our success.
So it's how many layers of mitigation do you need to have in order for this to work? And is there a magic number?
Are you asking specifically factors that go into our decision-making skill, our decision-making and due diligence?
Yeah. What does that look like? How much do you guys think you're, because the model, the model that, I'm going to sort of be putting money over into your organization. And now how many layers of variables do you look through to say, this actually is a low risk situation?
Yeah. So for us specifically, that's going to look different than, say, the individual investor. So that's why I wanted to get specifics of your question. So what I would have to say for an individual investor as they're looking at is going to be a little bit different. But to go back to us specifically, number one, we believe in, one of two markets. It either needs to be a necessity market or it needs to be a luxury market, because in extremes is where things survive during any downturns. But more specifically, we have niches that we operate in, that operate inside those spaces, and we won't move into any investment unless it meets our 11-point proprietary system. And so our investments have to match every single detail through that system before we would even consider moving into that market. And then, of course, there's the due diligence of the specific investment property that in and of itself, outside of those market factors.
All right, so that's an interesting thought. So in order for you as a business to scale as Boron Capital, you came up with this system of, 1, 2, 3, 4, 5, 6, and so forth, things that you have, things that have to be met. I guess that would be a good basic fundamental practice for any individual investor as well, right?
Mm-hmm. Yeah, so this system has been something that we've crafted over our 12 years, but not just in and of our own right. A large portion of this we put together with, if you recall, for those of you who missed episode one of our previous board members and one of our mentors is Keith Cunningham. And so he's kind of the king of optics and metrics, making sure you know how to analyze every detail of your business and every detail of a market, and very, very extreme inside those optics and metrics. So part of our time working with him, our time working with, Tony Robbins and other experts in said industries, we've collaborated and been able to come up with this system. And so one thing I would say, and like you said, for individual investors, what I would say to them is you need to know what you're looking for. You need to know what makes sense for you, and you need to know what you can replicate and duplicate over and over again with success. And so what I would say is, for you, just as for us, we're looking for the things that we know work and can sustain the test of time. So we only move into markets that we can easily replicate and duplicate, and markets that we are experts in. We don't step outside of our boundaries. We don't step outside of our wheelhouse without first becoming experts inside the market.
Okay. All right. So when I think about, I loved your statement about in the extremes. That was an interesting way to put it there, Zach, that you said that in any sort of, say that again, it's like in any sort of downturn, things tend to survive in the extremes. Oh, you use your magic phrase there again, Zach.
Yeah, to be specific, in any market downturn, the businesses that are going to survive, or rather the investments, are the ones that operate in extremes. So rather it be extreme necessity or extreme luxury. So even during downturns, what ends up happening is the financial gap becomes larger. And so your businesses are going to do best in extremes.
Okay, that's fascinating. So I guess if whatever you're investing in, you should always maybe keep that in mind during those downturns. But these are, and you're looking at really long-term objectives or perspectives or timelines when you do that, right?
Yeah, so part of our market niches is we're looking at 100-year growth trends. And so the niches that we operate in are niches and specific industries that have had growth trends over the last 100 years.
Okay, that's fascinating. Very macro level perspective. So let me ask you this question. Let's say someone listening to this was saying, hey, I could either take my money and just go invest in buying some of, say another residential property, buy another house or another condo or apartments or whatever, some other sort of property management where I'm in control and I can make updates and changes and try to move or flip the money a little more quickly. What would you say to that if someone is thinking that versus, putting money with your investing approach?
When it comes, well, if we're looking at the difference between commercial and residential, we have to understand how we're protecting our money. And so inside the residential space, you're a 1-to-1 ratio when it comes to, say, a renter, a buyer, and your actual product. With what we do, it's at a much more larger scale. So we have thousands of customers that come to our business. And so what happens is, if you're off by a small amount in residential, if the market shifts by a small amount in residential, it's very easy to go from 0% or 100% occupied to 0% occupied. But our occupancy is dependent upon many, many, many people. And so we have much fewer and smaller shifts whenever markets change. And so we're always looking for as many hedges of protection as possible. And so in residential, there's not many hedges of protection. And so we have built in diversification, not just through the amount of properties that you can invest in with us, right? So in a fund, we're housing multiple properties, and each property is in a different location. So you're diversified against that specific market economy as well. And then, of course, you have the business side is owned by us as well. So we're controlling as many factors as possible. And I would encourage anyone to get into investments where they can do the same thing, control as many factors as possible.
That's interesting as you described that. Certainly I have friends that have gone into the into the residential, bought additional properties, flipped them, and done very well. In the same manner, I have friends that have also attempted to do that, other friends, and it didn't go well. Whether it was they lost tenancy, and so therefore they started to really get underwater. Everything, their personal finances got directly exposed, right, to that. And so on a monthly basis, right, they're trying to manage multiple mortgages, if you will. And so I've seen both sides of it. So I like the way that your response to my question was all around protection. That's where you went first and foremost. You guys really practice this, right? And it's like the very first thing you said to that big, okay, all right, because a lot of us out there are thinking, hey, I could just go buy some other property. And again, there are some people that do that really well. But I think the thing that's really impressive is this notion of protecting by having lots of different variables, including not only economic variables, but just, long-term variables. You're looking at long-term trends. You're also looking at the number of people that are involved too. So it'd be shifting of sentiment, right? Shifting of population. So does sentiment analysis come into this at all as you see, crowds and groups of attention change and start buying other things, as the economy changes and people's desires change?
Yes, absolutely. And just to go back to the previous question, Grant, I'm not saying that a residential investor can't do well. What I am saying is that to do well as a residential investor, you need to be an active investor, and it's going to require you to become an expert in your field. Now, we have to determine as a listener, you're trying to determine, are you trying to become an active investor and go make this a new job, or are you trying to become a passive investor? So as a passive investor, what I would tell people is that investment dollars are best spent aligned with other experts. So rather than trying to go become a new expert in a new field and leaving your current position, you become great at what you're great at. And then you align with other experts to help expand your ability to create wealth. And so we would call that a business ally. And so creating business allies helps you expand outside of yourself and helps you grow exponentially rather than trying to carry everything all on your own shoulders. But moving forward into the next question, markets. So we're only moving into markets that have a long growth trend and are emerging markets. So markets that meet, like I said, that 11-point proprietary system where everything from the demographics to, the the depth of feasibility study that goes into our markets is pretty wild. But we're going to know everything down to the smallest degree. We know every single competitor in the market. We know everything they're doing from top to bottom. We know everything the rest of the country's doing. We know everything that the population's doing, from its distance from certain things, its incomes, its growth charts, things like that. I mean, it's a very in-depth process. So that's another thing that goes into what we're doing is we've been highly trained and highly skilled in picking the markets where these things happen, and knowing that those markets have growth trends, not just the industry or the specific business.
Are you looking at the stock market or the financial markets as well, in terms of understanding that sentiment, how things are growing, just overall trends?
Absolutely. So the market is always going to be the market. And the one thing that we know about the market is that we can't control it. And so, it's important for us to know what's going on. It's important for us to know how things are shifting and how they would impact areas and markets and things like that. And so the big picture financial market is the main reason why we do what we do. It's the main reason why we've created this fund. It's the main reason why we wanted stable, long-term investments. I see most people in the market, or rather, in any investment, they practice, especially the passive investor, they're practicing the notion of long-term growth and hoping that they will see a good rate of return or a decent rate of return when the time comes to retire. And most investments I see are either leaving out quality protection or they're leaving out quality production. And so the only thing that comes to mind for me, and the one thing that our investors were really looking for, is I want to be able to put my money somewhere where I can count on it. I want to be able to put my money somewhere that actually protects it and has backing, rather than just leaving the whole principal out in the market.
Okay. I love how you keep coming back to that. It's looking for those two things in every investment situation: the protection and then the production. Let me ask you this question around interest rates. So, what impact does current interest rates coming out of the Fed have on the funds and the properties that you're managing?
Yeah, really good question. I appreciate you asking this. And this is something that really differentiates our fund from a majority of other large commercial real estate investment firms. Is a big trend right now inside commercial real estate is obviously the multifamily business. And so, we've operated there and we've done well there. But in any real estate market, there's a time to buy and there's a time to sell. And even sometimes there's a time to hold. And so what we found is that right now is not the time to buy for large multifamily. It has become highly overpriced. And the one thing that everyone's doing out there is they have very high leverage, which means they carry very high debt on the property. And so when you bring up bank debt, you notice that, yes, the interest rates are going up. And so majority of these other places are going into these markets where they might be carrying 80% bank debt and have the other 20% financed through investors. So essentially, they have 100% debt on these properties. And if we go back to when real estate dropped in 06, 07, 08, what we'll actually see is that it was more due to over-lending on properties. And then, there's way more to it than just that. I think there was a lot of issues. It wasn't the real estate market that tanked. It was overinflated, and the banks were lending massive amounts of money on properties that couldn't sustain that evaluation. And so as interest rates are rising right now, you're seeing people have more and more debt, which means their margins get smaller and smaller. And so let me get to the point. The difference in what we do, and for anybody that wants to get into the specifics, welcome to get on a call with me, but I will tell you that we virtually carry no debt on any property inside of our fund.
That's amazing. Yeah, that was probably the main question in my mind. Like I said, because I've been discussing this with my wife for the last week since we last talked. I was like, oh man, if they're financing, all of this stuff, right, then they're going to be subject to these changes, right, et cetera. That's a huge differentiator, I think, for you guys.
Yeah, and what that means is not only do we have a very large protection barrier between principal investment and property value, which helps protect us and our investors, but it also increases our margin significantly. So then on the production side, we know that we have very, very high margins because we're not owing all of our profits to, say, a bank or to investors or things like that, which then creates a very large buffer between amount produced and what's being paid out to our investors. So that creates another large barrier of protection for our investors and ensures that they can get paid that fixed rate. And so it's a really attractive thing for everyone we deal with, knowing that not only are they secured by the collateralized position in the real estate, but knowing that they have a lien position and they're not going to have to, owe it, battle it out with a bank, and things like that, knowing that they're first in line and knowing that there is that barrier of production between their pay and what the property is actually doing because we have such higher margins.
The one last time, I think it was the last time we spoke, I asked a question around the ability to pull money out, right? Things change in people's lives. And you addressed that at the time. You said, well, it's a 5-year commitment, if I recall. You said if there's a significant emergency, obviously, things are workable and you can figure out a solution on that. What about going just the other way? What if you got involved and turned out, oh, gee, want to be able to put more in? How does that work? Is it drawing up an additional set of papers, or is that a whole new investment strategy, or what happens there?
Yeah, great question. So as an investor, or let me back up. In the investment fund, we do put a cap per fund, not per investor. So the way it works is each fund is only going to be a certain size. So we don't just keep adding and adding and adding to these funds. What we do is we raise to a certain limit. We have a certain standard where we cap off this fund. That fund will then close, and then we open a new one. That allows us to maintain the integrity of each fund and maintain the appropriate dollar value, equity value versus investment. And so as an investor, we continue to duplicate and replicate these funds. And so, yes, at any point, if you want to put more in, you have the ability to continue to invest with us to any number. It just depends on, I can't say for a fact that you'd be in on the exact same fund or set of properties that you were in the first time.
Okay, gotcha. All right, so you broke it up across, and I guess, because there's certain commitments that are made for that fund, so you can't go in and necessarily change those midstream. Is that right?
Right, because you just always got to think, we have to maintain the integrity, which means we have to have the appropriate equity position versus investment amount. And so if we continue to take investments on the same property, you could run into a situation where you become under collateralized, and then we'd be exposing ourselves and our investors to being in a bad position. So we make sure that our collateral position is much higher, or our equity position is much higher than the monetary investment to build in that protection. And so what we do is we have our system, we know exactly what we're good at, and these things become a sort of copy and paste so that we can duplicate and scale. So you continue to invest into the same style of package, but it may not be the exact same properties.
All right, so I think probably for me the main outstanding question is the roadmap, and I know I've hit that several times. I think having a roadmap for people to arrive and to get to a point where they can participate in these kinds of funds is going to still benefit by having the same discipline that you exercise at the commercial level that someone's going to practice at the individual level, right? So it's the roadmap of protection first, and then production. And then over time is then you build that capital or that net worth to be able to do that. Then it puts you in an opportunity to be a passive. The thing that seems challenging on that is that the individual investor needs to have the qualities of some of the commercial pros like yourself in order to be able to participate at those levels. Do you have any tips or guidance for people as they try to go from where they are and then get to a point where then they can participate? And you see my point? It's they have to act as a active investor. They have to have the skills of a commercial expert like yourself in order to eventually get to a point where then a commercial person like yourself and Boron could then take that money and then allow that investor to become passive.
Well, I don't know that I necessarily agree there. I'm not asking anyone to go into real estate prior to working with an expert. We have opportunities for people at smaller levels, but the direction of our focus has been on our fund, which does require accreditation. And so backing up just a little bit, if I'm reverse engineering the question, what I hear you saying is that how does a person get to the point of becoming an accredited investor? And so that's what I'd like to answer. And so a couple tips I would say is, number one, the first thing where you're at, if you're on a single income, if you're on a single job, the first thing you need to be asking yourself is, how can I grow my income? How can I get into a position where I am earning more money? And then the second would be, I would say, don't save to save, save to invest. So if you know what you're looking to do, if you know what your goal is, if your goal is to one day work with us, you're going to set that dollar amount and you're going to be saving for that point. So save with the intention of investing. So the first one would be max out your current income, max out where you're at, grow that, become that expert in that area. And I'm not saying you have to stay where you're at, but find the lane that you want to work in, find the lane that you want to become an expert in, and go and max out that lane. And then from there, save to invest. And then start looking at things of, how can I add additional streams of income? So how can I add more cash flow coming in? So you're evaluating once again, and this is where I was at. If you remember on the first call, we spoke about what I had to do is I had to take a serious audit of where I was at and what I wanted. And I would encourage everyone to do the same. What is it you want? Get clear about where you want to go. Start with the end in mind. And then you're going to know, if you ask yourself, where do I want to go, and get clear. Then you got to get clear of where am I at in relationship to those goals. And then you start asking yourself some quality questions. And that quality question would be, then what must I do to get there? And so there's many good books out there that outline certain principles that I would agree with. There's many great books out there and that I would recommend. And so it just becomes instilling the disciplines and knowing exactly what you're going after. So I'm not saying you need to go become a commercial investor, because it's not right for everyone. And it does take a lot of time, and it does take a lot of learning and a lot of education. It's not easy. Right. Like you mentioned before, getting into real estate, there's a lot of people that have done it wrong. And so I don't think that it's real estate in and of itself that's ever caused these problems. The real estate didn't cause the problems back in 06, 07, 08. It wasn't the real estate that crashed. You know, it's interesting. I saw an interview with a gentleman speaking to it. And this guy was assigned. He was assigned to be a lead reporter on everything that happened. And he was interviewing all the people involved in the different minds that knew what happened. And he was struggling to figure out how this could have happened. How did this collapse happen? And it was very interesting. He said, I sat down with somebody, and the gentleman looked at me, and he said, the reason you're not understanding it is because you still look at it from an economic level. He's like, you're looking at this as an economy report. He's like, the minute you start looking at it as a criminal case, you will understand what happened, and it'll all make sense. What happened back then, what happened back then was outside of just the economy. There was more things going on than what happened. And so many people were harmed and hurt, but as a real estate investor, we still made money then. And so real estate in and of itself wasn't the issue. It was, problems outside of that. And so,
and in fact, as you and I had talked, in fact, I think it was after we recorded the last podcast together, we talked about this a little bit, and there were some things going on in the financial markets in terms of the way that those mortgages were bundled up and packaged and sold as securities on the market. These were bad loan decisions, right? But they were sold.
Absolutely.
They were sold as grade A investments on the stock market. And so people are trading them and investing on them. And as you know, when you do investing and trading in the markets, there's more secured ways of doing it and less secured. And so it turned out that some of those were less secured investments on those securities. So that then less
secure than presented.
That's right. So you had two problems. You had the problem that what you're selling was actually a piece of crap, right?
Mm-hmm.
Where you're buying what you were buying and selling on the stock market represented a ball of badness, right? That was the first problem. Second problem is your stock trading or options trading investment strategies on that thing. There's more secure and less secure ways to do that. And some of those were less secured ways. So you have this double-edged sword, which was both edges were bad. When the first started to fall, there was no one to take the other side of the trades. And once everyone realized, hey, this is a ball of crap, all of a sudden down it went. So you're right. There was a lot more going on that actually interestingly tied the world that, you work closely with and the world I work closely with, and combination of those and bad decisions, misrepresentation, which I loved your comment about looking at it as a criminal case, because I thought, this was
because
this is criminal. This is not right.
Yeah.
I absolutely agree. Zach, so you've taken us full circle. We started your journey and you told us about where you came from and how you use the resources that are available. And so that's why I wanted to end with that. I wanted to come full circle to, wait a minute, where do we all start? We started with your journey, which was you were in the position that a lot of people are in, right? Which is, okay, I've got this desire and I have a finite set of resources. What do I do to get to the next level? And you said, set the goals, use the resources that you have, and then save to invest and continue to build that up. Over time, then you accomplish the goal, and by myriads of ways, doors get open that help you to accomplish what your objective is and what you're after. Ultimately, then it led to this incredible opportunity, and then you've handled so well these scourging objections that I threw at you today. You doing okay after all that?
I am feeling good.
Good.
No, it's good. I appreciate it, because the truth is everybody's going to have questions and they need to have those answered. And so that's the one thing that I appreciate whenever I have, say, a tough investor sitting across from me, because I know that when everything shakes out, it's going to look good and it'll fall in our favor, because we are who we say we are. And I know what we do. And that's just what it comes down to, is people have to get clear on what they want and get clear on if this is what they want. And so I just know that when everything's presented appropriately and once it's fully understood, that if it's the right thing, then we'll get to do business together.
Hey, I got to ask you just one more question. Just something you said just popped. I can't leave this one alone. So, and you and I talked about it, right? And it's this perception that, sometimes we have, that we feel safer driving our cars than we do getting on an airplane. Now, you know what I'm getting at, right?
Go ahead.
So what I'm getting at is sometimes, we're thinking, okay, I've collected this money and I've done this work and I've got to this point. oh, shoot, I feel a lot safer with me behind the wheel driving this thing than me getting on an airplane. The metaphor is, me turning over my assets, right, to some other organization.
Right.
I still think statistically, right, airplanes are still commercial aircraft, I'll say, right, are still safer statistically anyway than driving. I imagine you run into that a little bit when you're talking with people as they try to decide, well, let's see, do I really know more than Blake and then Zach and what Boron's doing? Maybe I can drive this car better than they can fly the plane. What do you do to help people get through that?
Yeah, it just goes back to what we spoke about earlier. It goes back to your ability, and I'll speak. Let's get broad first. You're gonna have to invest your money somewhere, right? What the decision really becomes is how and where. Do I want my money somewhere with low protection, uncertainty, instability, or do I want to get into something that's stable and hedges protection or risk in the most appropriate way? Now, protection isn't everything. Like I said, an investment has to have both. The truth is, in the market, I feel like you have a good opportunity for production, but there's not a strong amount of protection when you're out in the market. And this is for the passive investor. Okay. Now, if you're going to go all in and you want to handle your own things and you're going to be placing specific, trades and your exact strategy and you're living by it, then by all means. But when it comes to your average investor, and we're going to place our basket somewhere, right? Or put our eggs in a certain basket. The market does have good opportunity for production, but like I said, not maybe a lot in terms of protection. Then we look at the alternatives, and I think these are not good alternatives. When we're looking back at stocks, bonds, CDs, bank accounts, things like this. Well, it was the banks and the bonds and things like that caused the problems back in 08. But here's the truth, right? They're insuring you. They're giving you a fixed rate, but the truth is you're not getting a fixed rate over 1% to 2%. And the reality is that inflation is growing faster than your money, which means that the only thing you're guaranteed in one of those is that you're going to lose money every year. Most people think they're safe, but I would say it's the exact opposite. I would say the only thing you're guaranteed is to lose money. And so we have to find something that brings both. But to answer your question on as an individual investor versus an expert, it all comes down to, do you want to be the guy who go or gal that's going to go and learn every intricate detail of these markets? And then also we know that head knowledge is still not the same as applied knowledge. And so with a company like ours, we've not only aligned with all the best and brightest in minds, but we have the applied knowledge inside the space as well. And so that experience combined with continued research is what sets an expert apart from that individual investor. And so what we can do most effectively is we can put all your money to work. Because if you really believed in an investment, you'd be able to put all your money there. The truth is, people only dabble in things because they don't trust it. And so regardless of if you have to ask yourself the question, do I trust myself to put all my money to work? And so, on somebody with $1 million, if they only trust themselves enough to put 50 grand in, and even if they double their money, had 100% return on 50 grand, well, guess what? That 100% return only made you 50 grand. An 8% return on the full pot would have made you 80. Mm-hmm. So that's what it comes down to. Do you trust the person you're working with to be able to put your money all in? And so if you want to hold on to it yourself, what you're risking is your ability to scale. You're risking your ability to, and then give yourself some peace of mind, because control comes with a lot of responsibility. It comes with a lot of time investment, education investment, and everything that goes into it. And do you have the time or desire to go and learn a completely new job? Because that's what you'd be taking on as a full-time job.
Yeah,
so it just comes down to what's right for you.
Yeah. That's right. What's right, and certainly what your aptitude, your interests are. What do you believe your risk tolerance is, and so forth. Man, Zach, thank you so much for taking on all of these questions. I really appreciate you taking the time. How is what's that link again that people can reach out?
It's www.Boron Capital, BORON Capital, REI, as in real estate investment.com/invest now.
Very good. Very good. That's awesome. Thank you again, Zach. Any final words before we wrap?
No, I think we've covered it today, Grant. Appreciate you guys.
Thank you, sir. Okay, everybody, thanks for joining. Until next time, find a good mentor.
Thank you for joining Grant on Financial Investing Radio. Remember to subscribe and leave feedback. Don't forget to download your free roadmap to high probability financial control before you make an investment decision. Visit financialinvestingradio.com now.